real estate investment mortgage instrument. Get ready because it's time to raise the stakes with real estate. Like with any other specialized area, real estate has its own specialized terms and definitions, which we will continue on focusing in on here, referencing Investopedia, which is a place you can go to look up terms and definitions that are investment related and further your research there. We're focusing in on the mortgage here. In a prior presentation, we took a look at the promissory note. So we're looking at the notes and mortgages, focusing in on the mortgage. The note and the mortgage are not the same thing. So generally, when we think about, say, a home purchase or real estate, we think about the note and the mortgage as kind of packaged together, which is okay, but technically they're not the same thing. The note is an obligation to pay, in essence, the loan, while the mortgage pledges the property as security. So you have the loan, and then you have the pledging of the property as the security, in essence, the real estate supporting the loan, giving the lender then more security, which could influence the loan terms that would be involved, possibly lowering the interest rate lower than it otherwise would have been due to the lower risk. So the mortgagor is the borrower, the mortgagee is the lender. This can be a little bit confusing because when we think about a loan, we think about the lender as, in essence, if it's the bank doing the lending, and then the lendee being the person that's getting the loan, that's going to be basically the borrower. It's when you think about the mortgage, however, notice you're the owner. If you own the property, then you're saying I own the property and I'm mortgaging it. So you are the mortgagor to the lender, who is then going to be the mortgagee, who is going to be the recipient of the mortgage in that case. So it's a kind of reverse that you might typically think of it, because when you think about, again, the loan, then the lender is going to be the bank, and the lendee would be then the person that is taking out the loan. So this is often confused by people who are new to the industry. Minimum mortgage requirements. Identification of the mortgagor and the mortgagee. So obviously we got to list who is who for the minimum mortgage requirements. Description of the property serving as security for the loan. So clearly if we're putting the loan on or some property as collateral, we need to be specific about what that property is. Covenants and cession and warranty. We'll take a look at that in a little bit more detail soon. Provision for release of dower rights. We'll take a look at that in a little bit more detail soon. Any other desired covenants and contractual agreements. So the covenant of cession. So seisin means possession, and the grantor warrants that they own the property and have the legal right to convey it. The dower rights. Dower rights, a real estate interest intended to protect a spouse who does not hold title. So to protect a spouse that does not hold title. Idaho, Arkansas, Kentucky are the only states that retain dower rights. Dower rights generally become effective after someone dies. Dower rights law entitles a surviving spouse to at least 1/3 of the deceased spouse's real property after they die. So that may or may not be then applicable to you. The important mortgage covenants. So important mortgage covenants include, and we'll go into some of these in more detail in future slides, so I'll go over them a little bit more quickly here. Funds for private mortgage insurance, charges and liens, hazard insurance, preservation and maintenance of the property, breach of contracts, transfer of property, or a beneficial interest in borrower due on sale clause. Continued here, borrower's rights to reinstate, right of entry, lender in possession, future advances, subordination clause. So we'll go into some of those in a bit more detail. So the private mortgage insurance, and we go into this in a little bit more detail in another presentation as well, but the private mortgage insurance, an insurance policy that protects a lender or title holder if the borrower defaults on the payments, passes away, or is otherwise unable to meet the contractual obligations of the mortgage. 3 types of mortgage insurance include private mortgage insurance, qualified mortgage insurance, premium, and mortgage title insurance. It should not be confused with the mortgage life insurance, which pertains to the protection of heirs if the borrower dies while owing mortgage payments. Then we have the mortgage lien. A mortgage lien is a legal right the lender has to take property if you fail to pay your debt. So in essence, we're talking about the mortgage here, the lien, then you're failing to pay the debt, allowing then possibly the property to be taken in order to settle the debt. So once again, a mortgage lien is a legal right. The lender has to take your property if you fail to pay your debt. Most people mix mortgages with the actual loans made to purchase the real estate. However, a mortgage is not simply a loan. So again, there's kind of that difference between the loan itself and the mortgage. They're kind of tied together. They're linked in some ways, but they serve, the two different functions within this process. So instead, it is an interest in the real property held by the lender, the lien holder, as protection in case the borrower fails to pay back the loan. So that's what the mortgage component does. Preservation and maintenance of property. So we'll take a look at this in a little bit more detail. Might look something like this. Borrower shall keep the property in good repair and shall not commit waste or permit impairment or deterioration of the property, and shall comply with the provisions of any lease if this deed of trust is on a leasehold. So in other words, you might have a condition, a clause in there to say, hey, you got to keep up the property, because if you're putting the property there as collateral, then it should be basically preservation and in good condition. Could be something that you as the borrower, as the lender, would want to make sure is a condition, so that in the event that there's going to be non-payment, that if you have to repossess the property is of value that should, of course, at least cover the loan. So borrower shall perform all of the borrower's obligations on any declarations, covenants, bylaws, rules, or other documents governing the use, ownership, or occupancy of the property. So then we have the due on sale clause, which could look something like this. Mortgagor shall not sell, convey, or otherwise transfer any interest in the premises, whether voluntarily or by operation of law, or agreed to do so without mortgagee's prior written consent, including a any sale, conveyance, encumbrance, assignment, or other transfer of, including installment, land sale contracts, or the grant of a security interest in all or part of the legal or equitable title to the premises, except as otherwise permitted hereunder. So I won't go into that in a little bit more detail. You can look at that in a little bit more detail here, but you can see why that would be important to the lender. At hazard insurance. So hazard insurance protects a property owner against damage caused by fires, severe storms, and other natural disaster. This could be important, of course, in certain circumstances, because, of course, once again, the lender, if they're going to fall back on being able to pick up the property in the event that there was a default on the payments were not made, they want to make sure that the property has value, that they'll be able to get the claim of the value on it. And so if the property is in danger in some way, this could be important. So it usually refers to a section of a general homeowner's insurance policy that protects the structure of the home. Mortgage lenders often require you to have homeowners insurance to get hazard coverage. In areas prone to certain risks, such as floods or landslides, homeowners often opt to take out separate or additional hazard insurance to cover specific contingencies. Assumption of mortgage. Mortgage assumption is the process of one borrower taking over or assuming another borrower's existing home loan. When you're assuming a loan, the outstanding balance, mortgage interest rate, repayment period, and other terms attached to that loan often don't change. An assumption mortgage might make sense for a home seller who is finding it difficult to attract potential home buyers, or for a buyer who is being priced out of the housing market due to higher rates. Then we have a junior mortgage, the idea of a junior mortgage, a mortgage that is subordinate to a first or prior senior mortgage. So you have the senior mortgage, the junior mortgage. It often refers to a second mortgage, but it could also be a third or fourth mortgage. So now we got to think about, okay, what's going to be the hierarchy of the loans? If we have a second mortgage in place, then if there was a default on the loans, then who has priority? In other words, if there was a default, you sell the home. What if you sell the home and you don't get enough money to cover everything that was supported, all the loans that were supported by the home? Who gets paid first, second, third, and so forth is going to be important to the lenders. Now, obviously, if you have the primary principal mortgage starting out, you're going to be concerned if someone else takes on, if they take on another loan and they put the home as collateral, then there's going to be a concern, well, who has first priority and second priority and so on in the event that the loans are not repaid. So in the case of a foreclosure, the senior first mortgage will be paid down first. Home equity loans and HELOCs are often used as second mortgages. Junior mortgages often carry higher interest rates and lower loan amounts and may be subject to additional restrictions and limitations. So if you're on a second mortgage, the second mortgage may result in higher rates because that would just make sense given the fact that they're taking on more risk because they're not going to be paid off in the event that loans aren't being paid first, right? If the loans aren't being paid, the house is repossessed and then sold, they're going to get as much money as they can on the sale. But if they don't get enough money on the sale to pay off the loans, who's going to get paid first? The primary mortgage and then the second. So it should still be covered in the event that the house goes up in value and so on. But if there's a decline in the market, then there's going to be who gets paid first, second, third, and so on. So homeowners may seek a junior mortgage to finance large purchases like home remodel, college tuition, or a new vehicle. Purchase money mortgage, a mortgage issued by the borrower by the seller of a home as part of the purchase transaction. May also be called a seller or owner financing. This is usually done in situations where the buyer cannot qualify for a mortgage through traditional lending. A purchase money mortgage can be used in situations where the buyer is assuming the seller's mortgage and the difference between the balance on the assumed mortgage and the sales price of the property is made up of seller financing. Then we have the subordination clause. So the subordination clause, a clause in an agreement which states that the current claim on any debts will take priority over other claims formed in other agreements made in future. So again, this has to do with the hierarchy of who has the claim in the event that there's going to be a default on the payment to have the bigger security. So the subordination is the act of yielding priority, meaning, subordinated one claim in essence to another. So if there's a problem, the higher claim will get paid first and so on. When a home is foreclosed and liquidated for cash, the first mortgage lender gets first priority on the sale proceeds. Any money that remains is used to pay down a second mortgage and then the third and so on. The further down the mortgage tier a claimant is, the less likely it will recover its loan amount. To adjust the priority of a loan in the event of default, a lender may demand a subordination clause without which loans take chronological precedence. So they're going to take the chronological precedence unless there's, a clause that's going to basically change that. A subordination clause effectively makes the current claim in the agreement senior to any other agreements that came along after the original agreement. These clauses are most commonly seen in mortgage contracts and bond issue agreements. Subordination clause continued. Subordination clauses are most commonly found in mortgage refinancing agreements. Think of a homeowner with a primary mortgage and a second mortgage. If the homeowner refinances his primary mortgage, this in effect means canceling the first mortgage and reissuing a new one. So now you've got mortgage one, you've got mortgage two out there. They want to refinance mortgage one, which already had the primary sequence, but you're basically now, reformatting it. So then the question, will that reshuffle the sequence in terms of the primary and secondary, since you're forming it at a later point in time? You're basically ending one agreement and starting another with the refinancing. What does that do to the ordering of first and second in the event that there's a default on the payment? When this happens, the second mortgage moves up the tier to the primary status, and the new mortgage becomes subordinate to the second mortgage. Due to this change in priority, most first lenders require that the second lender provide a signed subordination agreement agreeing to remain in its original secondary position. So if you're the primary lender and you're saying, hey, I'd like to give you a refinancing situation, but if I do that, I'm canceling my first contract, I'm putting in a second contract, and because it's made after your second mortgage with your other lender, it's going to put me my claim subordinate to them. So traditionally then, the general idea was to be saying, hey, look, secondary lender, you are the secondary lender. We would like to refinance over here without losing our status as the primary status in the event there is a default. You're not losing anything. You're still the secondary. Therefore, they have a subordination clause that could keep them in the primary position. So once again, due to this change in priority, most first lenders require that the second lender provide a signed subordination agreement agreeing to remain in its original second position. Normally, this process is a standard procedure of a refinance, so it should be something that it's a fairly standardized process. However, if the borrower's financial situation has worsened or if the value of the property has significantly declined, the second mortgage creditor may be unwilling to execute the subordination clause. So normally, under normal conditions, standard practice would be that the second would say, yeah, that's normal practice, let's go forward. But if there's been a decline or something and they feel like they're taking on more risk, then possibly they would say no and not do that, which would have a problem with the refinancing. So if the second lien holder provides a subordination clause, it allows the primary mortgages on the same property to have a higher claim. So your legal rights in a foreclosure, if you fall behind on your mortgage payments, your lender could try to take back your property through a foreclosure. Obviously, the process of foreclosing and then trying to reclaim the loan that they took out. That's the point of the mortgage, of the lien that took place. Before initiating a foreclosure proceeding, your loan servicer must send you a notice that the loan is in default and give you a chance to get caught up and avoid foreclosure. You also have the right to challenge a foreclosure if you think your lender made a mistake or has violated the law. Mortgage recast. A recast happens when a borrower pays a large sum toward the mortgage principal and the lender recalculates the loan based on the new balance. So if they pay also a large amount and they recalculate the loan based on the fact that there's been that large payment, when the lender recalculates the loan, they will create a new amortization schedule. An amortization schedule is a table of loan payments showing the principal and interest that comprises each payment until the loan is paid in full. We will be creating amortization schedules shortly. The primary benefit to the borrower of recasting a mortgage is the opportunity to reduce monthly payments. Negative amortization loans or option-adjusted rate mortgages, option ARMs, often have a mortgage recast clause part of the loan contract. Voluntary conveyance. Voluntary conveyance refers to an elective transfer of title from one individual to another without adequate consideration. Consideration refers to the compensation which is expected in return for property. Without it, the conveyor should be prepared to offer legal explanation for the transfer. So in other words, if you have voluntary conveyance, usually if there's a sale on the market, there needs to be consideration, meaning payment. For two parties have to have a consideration. One, there should be, benefit to both parties. So if there's not, in essence, benefit to both parties, you kind of need to be able to explain the circumstances as to why that would be the case, because that would be unusual, not like a normal arm's length market transaction generally. And then the short sale, finally, a house is sold for a price that is less than the amount still owed on the mortgage. So now you got a sale that happens for less than the amount of the loan, which is generally a problem, because then you may not be able to pay off the loan, because the point is you'd sell it generally for more and pay off the loan. So it is up to the mortgage lender to approve a short sale. The difference between the sale price and the mortgage amount may be forgiven by the lender, but not always. The financial consequences of a short sale are less severe for the seller than a foreclosure. So that could be an option. In lieu of a foreclosure. We might talk more about this kind of situation at a future point, but obviously when you're talking about the lender's side of things, they have the home as collateral. If the value of the loan becomes higher than the home value, possibly because they gave a loan out with little down payment and or the market price of the home went down, then you have a situation where sale can happen even at a market price. They're selling at the market price, but that market price is not high enough in order to pay off the loan. And then you've got a situation, well, what would be best for the financial institution in that case? It may still be beneficial for them to have the short sale take place, a sale that doesn't even cover the loan amount, as opposed to going through the process of the foreclosure, which could be more tedious to go through on the bank side, and which could be more detrimental on the homeowner side. So it's important for the buyer to calculate the costs and be sure there is room for profit when the house is resold.